there, everyone. We're back again for another good time with real estate and introduction to the profession. So we're going to be going over chapters 11 through 15 today. So sit back, relax. Hope everybody's had a good week, and look forward to going over all this good financial information with you. There's a lot to it, so just have your paper ready, and we'll go through the terms here. And again, we're going to be on chapter 11, and it's going to be lending practices. Okay, so let me start out on page 173. And the United States has had a long-standing commitment to individual home ownership. We have long had governmental assistance in the form of tax-deductible interest on mortgages and government-insured and guaranteed loans. We have standardized appraisal systems, standardized secondary mortgage markets, and a proliferation of loan originators. Okay? So, what are loans? So we have all kinds of different terms about loans here. Types of loans include, there's a term loan, requires only interest payments until the full amount borrowed is due, also known as a straight loan. Then you have amortized loan, regular equal payments for the life of the loan that include both interest and principal repayment. We have a budget mortgage. In addition to collecting the monthly principal and interest payment, like an amortized loan that we just talked about, the lending collects 1/12 of the estimated cost of the annual property taxes and hazard insurance on the mortgaged property. All right, that's a budget mortgage. Then we have a balloon loan. Okay, just like you would think of a balloon going up. Any loan that has a final payment larger than any of the previous payments. Okay, so it's actually goes and then it has this huge payment at the end of it. Okay, it's called a balloon loan. And then you have partially amortized loan. And this is a series of amortized payments with a balloon payment at maturity. And we're on 174 here with these. Repaying a 6-year, $1,000 loan. Okay, so you see here there's a term loan, and then you have an amortized loan. Again, this is on page 175. The amortized loan requires regular equal payments during the life of the loan. Reduce the amount owed to zero by the loan's maturity date. As you see there on the second one has amortized loan, and it's a constant payment until maturity date. At the end of the 6th year, the entire principal is due in one lump sum payment. Okay, and this is a term loan we're talking about here, and that's the first one there that's listed. So you have a constant loan, and then the whole, at the end of 6 years, the whole principal has to be paid off. Okay, so you see that big huge bar go up. So that's it's almost like a balloon payment at the end. Furthermore, the amortized loan shown here in this figure actually costs the borrower less than the term loan over time. Okay, so the amortized loan is usually a home loan that you'll have. There will be taxes and insurance with it, and over the period of time, it will cost less than a term loan. But if you actually reduce the years that you have it out, that will reduce the interest that you pay on the loan, and we'll go over that later. This is repaying a 6-year, $1,000 amortized loan. Okay, so you see it the first year there, all the way down to the 6th year. You see the principal payment at the beginning of the first year. The principal is being paid a certain amount, and then the interest. So you see the interest is a large amount there of the principal and interest payment. Well, if you go all the way down to the 6th year, you see how small the interest is. It's instead of $90, you would be paying the $18 in interest. So what it does, it amortizes, and what it does, it puts more money towards the principal over time, and the interest rate actually is less and less. And not the interest rate, but the interest that you're paying is less and less, because you're paying interest on the principal, and you're constantly knocking down that principal. So that actually, and that's how they do home loans usually. And then you see the other sketch balance owed during each year of the loan. So that's the repaying a 6-year, 1,000 amortized loan. So on page 178 and 179, paying a mortgage may include the following factors. Okay, you have a budget mortgage, you have a balloon loan, partially amortized loan, and early payoff. So first, the budget mortgage. This takes the amortized loan one step further. In addition to collecting the monthly principal and interest payments, often called P&I, the lender collects 1/12 of the estimated costs of the annual property tax and hazard insurance on the mortgaged property. Okay, that's a budget mortgage. A balloon loan, we talked about before, is any loan that has a final payment larger than the previous payments on the loan. The final payment is called the balloon payment. Partially amortized loan. When the repayment schedule of a loan calls for a series of amortized payments, followed by a balloon payment at maturity, it is called a partially amortized loan. For example, a lender might agree to a 30-year amortized schedule, which a lot of homes are financed for 30 years, with provision that at the end of the 10th year, all the remaining principal will be paid in a single balloon payment. Okay, so that can be set up that way. Banks, they have all different ways they set up the loans, and you can actually work out even your own kind of schedule if you wanted to. You can cut back. We're going to talk about making 2 payments instead of 1 payment a month. Sorry about that. And that will actually pay off your loan faster. So we'll talk about that here soon. So we have early payoff, okay? And we just talked about that. We have 15-year loan, which is, of course, if you have a mortgage, you can have a 15-year mortgage, you can have a 10-year mortgage, 25 or 30, and now they're even doing 40-year mortgages. They're extending out even more, some companies, because the houses have just gotten so expensive. And but if you go by a lot of the financial gurus out there, they'll say that you shouldn't have more than a 15-year loan, because if you have a 30-year loan, the interest rate will just eat you up. You can spend hundreds of thousands more on the loan if you continue that 30 years instead of 15 years. So on the bi-weekly payments they have here, we talked about just a minute ago, instead of paying once a month, the borrower makes 1/2 the month payment every 2 weeks. Assume you borrow $100,000 at 7% interest, paying $666 per month. You will retire the loan in 30 years at a cost of $139,509 in interest. Okay, so just $139,000 in interest is a lot of money that the bank makes over the period of that loan. If you decide to pay half of $666 every 2 weeks, the loan will be fully paid in just 18 years, okay, because it cuts that interest, and will have cost you $105,046. So that's over $30,000 in savings you'll be able to have over that period. Then we have existing loans. Borrowers with existing loans who want to celebrate with an early mortgage burning can simply add a few dollars each month to the required payment of the month. So you can pay off your mortgage a lot sooner if you add more principal on top of your regular payment every month, and that'll pay it down very quickly. And this way you can do it without having to refinance the loan. If you have a good interest rate and all that, and you don't want to mess with that, then you could do it that way. They show here in the book an amortized table, monthly payment per $1,000 of a loan. They have a 15-year, so they have 5 years all the way to 40 years, okay? And they have on the other side the interest. So you have a 5% interest starting out, and then it's all the way up to 15% interest. And it just shows you how over the years the rate will actually drop for the interest rate. So for the monthly payment of $1,000. $1,000 a month. So it's kind of interesting to see that. Loan to value. All right, so we have loan to value. This is page 181. Loan to value ratio. The relationship between the amount of money a lender is willing to loan and the lender's estimate of market value of the property that will serve as security. Okay, often abbreviated LV or LTV ratio. So you have a market value of $100,000 on your house. You have a loan of $80,000. What is the loan to value? That's 80%. Okay, so most conventional loans out there, they want you to have this 80% ratio. So what you'd have to do is, for a conventional loan, pay down 20% of the loan at closing, and then you finance the rest of the 80%. Okay, a lot of people can't do that because you have to save up a lot of money to be able to pay down that 20%. Just think of 20% of a $300,000 house, then you have to bring a good amount to the closing table. So what they'll do is these other kind of loans, which I'll go over here in a little bit, that actually, instead of 20%, you can get it in for 3%, like a FHA loan and all these other ones, but we'll go over that here soon. Loan terminology. Some important loan terminology includes the following. Okay, and this is on page 181 also. You have equity. All right. You got loan points, origination fee, discount points. Okay, that goes under loan points. So equity. Equity is the difference between the market value of the property and the debt owned against it. It's called your equity. As the value of the property rises or falls and the mortgage loan is paid down, the equity changes. So it goes up and down. It all depends. If the owner completely repays the loan so that there is no debt against that home, the owner's equity is equal to the market value of the property. So, what's your equity? So a lot of times you can actually borrow on your equity of your house. So once you pay down your house, you might have pay it down 80%, okay, from the 100% that you owed on it. Well, you have that 20% there. You can actually borrow that from the bank as a second mortgage and use it on, you could build another room onto your house, you could update everything, whatever you want to do with the money pretty much. But it can be a second mortgage, and this is the equity, so it's an equity loan that you get from the bank. And we'll be going over that too coming up. Loan points, you got origination fee. In finance, the word point means 1% of the loan amount. Okay, so when you go to a bank and they say, okay, well, you can go ahead and, at closing, you can pay down 1 point on the loan, and we'll give you a better interest rate. Okay, they might cut the interest rate by, 0.25% or whatever. So instead of 3.25, it would just be a 3% loan of interest on the loan. So that point that you pay is 1% of the amount of the loan itself. So thus, of a $100,000 loan, 1 point is $1,000. Next, we have origination fee. When a borrower asks for a mortgage loan, the lender incurs a number of expenses, including such things as time its loan officer spends interviewing the borrower. Okay, so the time that they come and say, hey, how you doing? My name is so-and-so, and what do you need? And all this other stuff. Well, they get paid for that. Office overhead, everything that they have to print, do whatever. The purchase and review of credit reports. They have to run credit reports on you. They have to get all that information, and there's origination fees on that. Okay, so that's what that is. So with discount points also, page 182, points charged to raise the lender's monetary return on a loan are known as discount points. Instead of handing the borrower $100, you handed him $99, but still required him to pay $100 plus $10 in interest at the end of the year. This is a discount, 1 point or $1 in this case. Okay, so that's discount points. They use those also. This is a VA FHA comparison. Okay, so they're showing you different lending practices out there that are government ran, and you can get FHA there, it says 3.5% down. All right. So, and 96.5% loan to value. So they can loan you up to 96% of the loan. So that they actually insure loans. UFMIP, we're going to go over that here in a minute. Anyone can qualify for it. Rate is negotiable, of course, always negotiable. Points that you can pay down. And then, again, you only would have to pay down 3.5% instead of the 20% on a conventional loan. This is not a conventional loan, this is FHA loan, okay? Federal Housing Administration, so it's a government backed. And most loans are done this way because, again, people don't have 20% to put down, and they go through FHA, and it is a more strenuous inspection process and all that other stuff because it is government run. Then you have Department of Veteran Affairs. So people that go to the military, they can actually get a discount when buying a house. This guarantees the loans. There is a funding fee. Veterans only can get this. Rate is negotiable. They have points also. No down payment. Okay, and then they can finance 100% of the loan. So it's a lot different than the FHA. VA is a really good deal to be able to get into a house if you're a veteran. You can finance 100% of the loan. So pretty good stuff. VA and FHA similarities. Some similarities include owner-occupied. It has to be owner-occupied. You can't have a rental or whatever else. If you're getting this loan, you have to live in the house. 1 to 4 family dwellings. Refinancing is allowed, and then assumption allowed with approval. So if somebody's going to assume the loan, then it has to be approved through FHA or VA. These are different websites that you can go to. VA is www.homeloans.va.gov. The FHA is that one there, the HUD, and the conventional is the FannieMae.com. So those are just different websites, and all you have to do is Google it. You can put in VA or FHA or conventional, and it'll go bam, and they'll show you all the different sites that you can pull up, get more information on it. And we go into mortgage insurance. This is on page 190. Mortgage insurance was formed to insure home mortgage loans. Okay? Some important terms of mortgage insurance includes you have private mortgage insurance, you have PMI conventional, UFMIP FHA, which we talked about, VA loan guarantee, and insurers lending against losses. All right, so on page 190, we got private mortgage insurance. This is to insure lenders against foreclosure losses. Okay, and they make you buy this a lot of times in case, and then once it gets paid down a certain amount, you can stop paying it, and we'll go over that here soon. The borrower can purchase home with a cash down payment of either 10 or 5% rather than the 20 to 30% down required by lenders when mortgage insurance is not purchased. Okay, so you get a better deal. You don't have to put so much down. For this privilege, the borrower pays a PMI fee, all right, of 1% or less when the loan is made, plus an annual fee of a fraction of 1%. All right. In 1999, Congress passed the Homeowners Protection Act, HPA, which became effective in 2000. The act requires services to automatically cancel PMI, so they take it off of your monthly payment, once the loan reaches 78% of the property's original value. So between 78 and 80%. The act also requires notification to the borrower that they can request PMI cancellation when their equity reaches 80% of the property value. Okay, so you can go ahead and request it at 80%, but they'll go ahead and knock it off at 78%. They're saying. Sometimes PMI is probably about $125. I've seen before, and that's tacked on to your monthly mortgage rate, your monthly mortgage payment. So if your payment's $900, then you're looking, right at $1,025 for the payment, and because of that PMI is on there. So once it's paid down to the 80%, you can say, hey, take that $125 off. I need to go buy groceries with that. So they can do that, and you don't have to ever pay on that mortgage again. So that just covers them from foreclosure losses. Rural Housing Service Administration. So this is RHSA. Rural Housing Service Administration, a federal agency under the U.S. Department of Agriculture. Like the FHA, it came into existence due to the financial crisis of the 1930s. This offers programs to help purchase or operate farms. Okay, so that's Rural Housing Service Administration. And then for lending practices chapter, we have the key terms. We went over the amortized loan, balloon loan, all the other, the equity. Please read through everything because there is a lot more information within the chapters. But I did highlight the key elements in here. I'm going to go ahead and tell you the chapter code for chapter 11. Chapter code is balloon. So for balloon payment, I'm just saying balloon. So remember that, and you'll be emailing that to me. So let's go to chapter 12. Moving right along here. And hope everybody's staying healthy out there and enjoying this beautiful weather we have. And this chapter 12, the loan and the consumer. Okay, some more about loans and all this other financing and stuff. Almost all these chapters that we're going over today do talk about financing. So, the loan and the consumer. Truth in Lending Act. We'll be talking about a federal law that requires certain disclosures when extending or advertising credit. The act came into being because it was not uncommon to see loans advertised for rates lower than the borrower actually would wound up paying. Okay, so they would actually say that your rate to get you in the door would be this amount, but they would be lying to you. So they came with these different acts for truth, saying, hey, you better tell these people the correct thing, or you'll get fined, and all the other wonderful things that happen that can be taken to court or whatever for lying to you. So a lot deals with the advertising agencies and stuff. So again, a federal law that requires certain disclosures when extending or advertising credit. Regulation Z. This is the federal regulations that implement the enforcement of the Truth in Lending Act. Okay, so Regulation Z is a big deal. Here with advertising. Whether you're a real estate practitioner or a property owner acting on your own behalf, Truth in Lending rules affect you when you advertise just about anything, including real estate, and included financial terms in the ad. So with Regulation Z, it was the Federal Reserve Board, Regulation Z, requires the lender to show the borrower the cost of the credit. Okay, a form saying, hey, this is our costs all broken down of what it's going to cost you for this credit. So amount financed, finance charges, annual percentage rate, and total payments. Okay, it's all going to be on there. So what is annual percentage rate? Right? This is one of the most helpful features of the law, as it gives prospective borrower a standardized yardstick by which to compare financing from different sources. You can say, okay, what's your APR on this? Okay, you can go to another bank, what's your APR? And you're able to measure and see which one is a better deal. If the annual percentage rate being offered is subject to increase after the transaction takes place, the fact must be stated. Okay? If you wish to say something about financing and avoid triggering full disclosure, you may use general statements. And you need to use general statements. You can't say, okay, the following would be acceptable. This is an assumable loan. All right? Financing available. Owner will carry. Terms to fit your budget. Easy monthly payments or FHA and VA financing available. Okay? Nothing really about percentages of real numbers. You don't want to put any of that in the ad. You want to be very generic, because with the truth in lending, you can get caught up with if something changes and you don't actually offer that, then you can be in real trouble with it. So again, the APR combines the interest rate with other costs of the loan. Everything put in there is the APR. All right, it's always different than your real interest rate that you pay, because this is everything that's built into the loan. All right. We did closings before, and everybody would look at the APR and they say, "Oh, well, they told me I was going to have a 3% interest rate." And we say, "Well, this is the APR, the annual percentage rate, and it's always more because it builds in everything into the loan." Okay, always had to explain that every time. So it combines interest rate with other costs in the loan into a single figure that shows the true annual cost of the borrowing. Loan estimate disclosures. So 4 different ones. Must be prominently displayed on papers the borrower signs are. Okay, you got loan terms, projected payments, annual percentage rate, and cost of closing. So this is on page 198. So you have loan amount, the amount of credit provided to the borrower. Okay, that is the loan amount. Exempt transactions. Certain transactions are exempt from lending disclosure requirements. The first exemption is for credit extended primarily for businesses, commercial, and agriculture purposes. The second exemption applies to credit over $25,000 secured by personal property, unless the property is principal residence of the borrower. It's got to be your principal residence. All right. Right to cancel. This is huge. Usually you have 3 business days, to be able to have a right to cancel from the paperwork. All right. Borrower has a limited right to rescission, which is right to cancel, with certain terms. Right to rescission. Borrower's right to cancel a credit transaction. You have 3 business days after signing the loan papers to back out. And after that 3 days, then it's very difficult to back out after that. This includes Saturdays. So a lot of banks are open on Saturdays, so they went ahead and included Saturdays. Does not apply to credit used for acquisition or initial construction of your principal dwelling. So it does not apply on those. Trigger terms and disclosures. All right. If any of the following are mentioned, so these are trigger terms: down payment, any payment, number of payments, period of payments, amount of any finance charge or statement, no charge for credit. All right. Then these disclosure must appear in the ad. So if you have any of those that are mentioned above, then you have to have cash price or loan amount, down payment or none, number, amount, frequency of payments on there, annual percentage rate, got to put that APR out there, and deferred payment price of total payments or total payments on there. So if you have those trigger terms, you got to have this in there too. They're very strict on this. So who must comply? Any person or firm that regularly extends consumer credit subject to a finance charge. Of course, that's banks, mortgage lenders, such as interest, or payable by written agreement in more than 4 installments. Must comply with the lending disclosures. The new TIL Act does not include mortgage brokers or real estate practitioners as creditors just because they brokered a deal containing financing. They do not appear as creditors on the note. All right? That's who must comply with it. The loan process. All right? This is on page 204. Lender qualifies the following. You got the borrower, you got the property, and you got the title. Lender begins an analysis of the borrower, and if there is one, the co-borrower. A lot of times you'll have 2 people on the loan. At one time, age, sex, and marital status played an important role in the lender's decision to lend or not to lend. Often the young and the old had trouble getting loans. as did women and persons who were single, divorced, or widowed. Today, the Federal Credit Opportunity Act prohibits discrimination based on age, sex, race, and marital status. Okay, this is a huge deal. You can't be prejudiced against any of these. So, actually, here in the office, on the back of the wall, has the Federal Equal Housing Opportunity Act right there. And it's got, it's illegal to discriminate against any person because of race, color, religion, sex, handicap, familial status, or national origin. And it's right there on the wall. And that has to be posted in any real estate company office, at least here in Tennessee. So I think it's all over the United States, but I know here in Tennessee we have to have it posted. So the monthly income, the lender looks at the amount and sources of the application's income. Lender will look carefully at overtime, bonus, and commission income in order to estimate the levels at which these may be expected to continue. So they're going to look at your income, they're going to make sure how much money you got coming in. That was the problem back in 2008. Before that, before the bubble, they were actually writing down any kind of income, and if you had some kind of income from anywhere, they would give you the loan. It was crazy back then, and that's what created the bubble. There was all these people that actually bought houses that couldn't afford them, and then we had the collapse of the real estate market after that, and that was one of the big problems. The lender compares what the applicants have been paying for housing with what they will be paying in the loan if the loan is approved. Okay? So we have redlining. Redlining is very bad. It's refusing to make loans in certain areas, and if a company is actually found that they're doing redlining, then they'll be closed and fined. No telling how much. So you cannot do that. Redlining in the past, it was not uncommon for lenders to refuse to make loans in certain neighborhoods, regardless of quality of the structure or the ability to the borrower to repay. Shut off mortgage loans in many older or so-called bad risk neighborhoods across the country. All right, that's what they did. Today, a lender cannot refuse to make a loan simply because of the age or location of the property, the neighborhood, income level, or racial, ethnic, or religious composition of the neighborhood. So, they have to go into any neighborhood and say, hey, we treat you guys just the same as we do the next neighborhood over. So, it's called redlining. Credit report. As part of the loan application, the lender will order a credit report of the applicant. Okay, so there's all kinds of different lending credit reports out there, and you can run your own. It's good to run your own. That way you see what's on your credit report. Sometimes somebody will they'll steal your credit, and they'll put something on there that they didn't pay for, and it shows up on your credit report, even though you didn't do it. So make sure you run your credit report once a year. That way you know what's going on. I had my identity stolen before, and they went out and they charged up things and found out that it was on the credit report and had to have it taken off. So it's not easy to get things taken off the credit report either. This provides the lender with an independent means of checking the applicant's credit history. Fair Credit Reporting Act. Federal law giving an individual the right to inspect his or her file with the credit bureaus and correct any errors. Okay? Like I said before, there could be errors on it. Credit scoring. Method used today to evaluate credit risk. Okay? It's called credit scoring. And they'll say, okay, is he a good credit risk or not? This is another reason to make sure you pay off your credit cards on time, because you don't want to lapse. Because every time you lapse, it'll put a huge ding in your credit report, and it'll show up there. So to be able to buy a house these days, you really have to have a very good credit rating and no lapses in anything. So just make sure you run your credit report and see what's on there. On page 209, we got the Consumer Financial Protection Bureau. They actually qualify mortgage rules, ATR rules, all right, new appraisal requirements they have, new foreclosure requirements. Lenders are now required to wait until borrowers are 120 days or more delinquent before sending an acceleration notice or filing for foreclosure. So now even the people have protection against the banks for actually sending a foreclosure notice to them. Then you have new forms, loan estimate form and closing disclosure form. So the predatory lending and mortgage fraud, okay, there's 12 practices considered to be predatory. Number 1, steering borrowers, like we talked about before. Engaging in practice of intentionally structuring high-cost loans to borrowers. Number 3, falsifying loan documents. 4, making loans to mentally incapacitated people. 5, forging signatures on loan documents. That's a no-no. Don't forge anybody's signature. Changing the loan terms at closing. You don't want to do that because they're going to say, hey, what's the deal here? 7, requiring the credit insurance. 8, falsifying identity loans as lines of credit. 9, increasing interest charges for loan payments. 10, charging excessive prepayment penalties. 11, failing to report good payments on borrowers. And then 12, failing to provide accurate loan balance and payoff amounts. So all 12 of those, that's predatory lending and mortgage fraud, and they break all of those down and make sure that that's not happening to the consumers. So, predatory lending again, when consumers lack the knowledge to evaluate lending practices and are preyed upon by unscrupulous lenders who take advantage of the lack of knowledge. All right. Mortgage fraud almost always involves a conspiracy between a loan originator and an appraiser. Additionally, conspirators can include a buyer's mortgage broker, a title company, and the seller's real estate agent. So, don't get caught up in mortgage fraud because it's bad news. They'll really fine you and you'll lose your not only your reputation but also your position. So again, the key terms of the consumer loan, we got APR, credit report, liquid assets, redlining, Regulation Z, and truth in lending. Okay, so all those. And flip over here. So the Chapter 12 code that you want to give me. The chapter code is APR. So annual percentage rate, it's APR. So we talked about that. And that is Chapter 12. So we're going to move right along to Chapter 13. And here we go. See all this financing, there's so much good information in it for everybody. And we try to make it as exciting as possible, but we'll get through it. And it's good to know because everyone out there is either going to rent or buy one day. So it actually it helps everyone out knowing these key terms. Sources of financing. Here we go. Chapter 13. So we have different markets. We've got a primary and a secondary market. All right. Primary market, the market in which lenders originate loans and make funds available to borrowers. That's the primary market. This primary market is what the borrower sees as a source of mortgage loan money. The institution with which the borrower has direct and personal contact. It's the place where the loan application is taken. When the loan officer interviews the loan applicant, when the loan check comes from, and the place to which loan payments are sent by the borrower. So this is your primary place that you send your loan payments. Then you have a secondary market. This provides a way for lenders to sell a loan. And what they'll do is, most lenders out there do this. Once you close on a piece of property, the bank that you close with will usually sell that loan, and they'll just make that money from selling the loan and also originating the first loan. All those origination fees and all that other stuff they make money on. So after you buy a house, it's very common where you'll be making a payment to one bank for 2 or 3 months, and then somebody sends you a letter and says, okay, this is where you send your new payment, okay, because they sold the loan to somebody, and that's one way that banks make money. This is on page 218. Primary loan sources. Entitles, there's different entities involved with mortgage financing include the following. You have a savings and loan association. You have commercial banks, life insurance companies. They even do loans. Mortgage companies, mortgage brokers, okay? We'll talk about all these. Municipal bonds, other lenders, and then computerized loan origination, and that's new out there. Primary lenders often sell their loans in what is called the secondary market, which we talked about. Insurance companies, pension funds, and individual investors, as well as other primary lenders with excess deposits, buy these loans for cash. This makes more money available in the primary lender, who in turn can loan those additional funds to more borrowers. Okay? So once they sell a loan, then they can take the money that they made and they can make more loans with it. So it's a constant grind that they got going on there. So you have savings and loan associations. This is traced to building societies in England and Germany back in the day, and to the first American building society. The Oxford Provident Building Association started in 1831 in Pennsylvania. As times progressed, savings and loan associations become a primary source of residential real estate loans. All right? So over time, savings and loans became huge and became primary. Then you have commercial banks. Everybody knows commercial banks. You got Regions, you got First American, just the whole list. Hundreds and hundreds of them. The nation's 15,000 commercial banks, okay, so they got 15,000 of them, store far more than the country's money, than the S&Ls. However, only one bank dollar in 6 goes to real estate lending. So remember that. Only one bank dollar in 6 goes to real estate lending. All the other money goes to other lending sources, like people's different people that are working out there that need money, need loans for their businesses, all that. Of the loans made by banks for real estate, the tendency is to emphasize short-term maturities and adjustable rate mortgages because the bulk of the bank's deposit money comes from demand deposits, which are checking accounts, and a much smaller portion from savings and time deposits. So their biggest thing is people's checking accounts and all that. It's not making loans for houses or whatever. They'll actually take that and sell it to the secondary market. And we have life insurance companies listed here. As a group, the nation's 2,200 life insurance companies have long been active investors in real estate as developers, owners, and long-term lenders. Although not federally regulated, life insurance companies are subject to state regulations. Their source of money is the premiums paid by the policy holders. Okay? That's how they make their money. Life insurance companies channel their funds primarily into government and corporate bonds and real estate. So, they're huge in the secondary market. Then you got mortgage companies. Makes a mortgage loan and then sells it to a long-term investor, which life insurance company. The process begins with locating borrowers, qualifying them, preparing the necessary loan papers, and finally making the loans. Once a loan is made, it is sold for cash on the secondary market. So that's mortgage companies. You have the banks loaning out, right? That sell it to the secondary mortgage. And you have mortgage companies selling to the secondary market. Then you have the mortgage brokers, which are people in between They actually find and brokerage the deals. In contrast to mortgage banks, these people specialize in bringing together borrowers and lenders, just as real estate brokers bring together buyers and sellers. Okay? So, the mortgage broker does not lend money and usually does not service the loan. He'll go to a secondary market. The mortgage broker fee is expressed in points. Remember what points are? We talked about that earlier. And is usually paid by the borrower. So they might charge 1 or 2 points of the loan. So that's how they make their money. So there's a lot of people in that business that say, oh, I'm a mortgage broker. Oh, okay. Well, now you know how they get paid. They get paid by points. Municipal bonds. In some cities, municipal bonds provide a source of mortgage money for home buyers. The special advantage to borrowers is that mutual bonds pay interest that is tax-free from federal income taxes. Pretty neat. The objective of such programs is to make home ownership more affordable for low and middle income households. Again, houses have gotten so expensive now that any help possible to be able to get that closing done so you can get into the house, there's so many different ways of doing it. So if you talk to your lender, they have all kinds of information on who you might be able to talk to get better interest rate or whatever government program out there to be able to use to get into a house. Then you have other lenders. You got pension funds and trust funds, all right? Pension funds, trust funds. Pension fund is from, people that have pensions out there, like the police department and all kinds of different pensions out there. Finance companies. There's credit unions out there, as you know. Commercial finance companies. And you have individuals that just want to invest. So, then you have the last one is computerized loan origination. There's a real estate brokers, attorneys, insurance agents, and mortgage companies can arrange to have a computerized link installed in their offices. Connected to lenders' mainframe computers, borrowers can obtain preliminary loan approval immediately from the loan originator with a firm acceptance or rejection from the lender institution within a few days. So it just makes everything so much faster. They can say, yes, we can go ahead and loan you this money for this new house. And they can get it to you within days. Before, it took a lot longer to get approval. But now they can approve it very quickly because this is our wonderful computer age we're in. Disintermediation. So disintermediation, the result created when lenders are required to pay high rates of interest for deposits while receiving long-term income from low interest rate mortgage loans. Okay, that's the definition. Computerized loan origination, again, we talked about originating loans through the use of network computer systems. So it provides information on current mortgage loan terms, types, loan types available, conveys loan application information electronically, monitors the loan approval process so that practitioner can check on the progress of the loan application at any time. So you go out there and say, okay, where we're at here, where are they at? So if you go over and get some food at Sonic, and you see once you pay for it, then it shows on the computer there, it shows in the kitchen, and it's just to go on here saying, come on guys, get that food out, I'm hungry, come on, send it. So then it goes over to preparation, and then finally they come out and bring you the food. So same situation here. You actually get to see the loan process, the approval process going on. So it's pretty neat. So you have a mortgage loan delivery system, just like at Sonic, like I just talked about. You got depositors, then it goes over to S&L Bank, and then to the borrower. Okay, so it goes over. Secondary market system, you have investors, then you have an investment banker, purchase or packager of the loan, then you have a mortgage origination, and then it goes to the borrower. All right, so that's how they process through the delivery system. So 223. The secondary market provides a way of lender to sell a loan, right? We talked about that. Secondary market purchasers include the following: Federal National Mortgage Association, FNMA or Fannie Mae. I'm sure you've heard about that before, Fannie Mae. Then you have the Government National Mortgage Association, Ginnie Mae, GNMA. Then you have Federal Home Loan Mortgage Corporation, or Freddie Mac. And then Federal Agriculture Mortgage Corporation, Farmer Mac. All right, so these here, these different agencies, Fannie Mae, Ginnie Mae, Freddie Mac, Farmer Mac, they almost back almost 80% of all loans, and it's the government backing. So they try to get where they don't back as many loans because of the drain on the system, but the secondary loan source is really something out there. So it's and it's government run. Participation certificates. So a participation certificate is represented as undivided interest in a Freddie Mac pool. All right. So Freddie Mac gives a mortgage originator a PC representing an undivided interest in a pool of investment quality conventional mortgages created for mortgages and mortgage interest purchased by Freddie Mac. So it's a participation. PCs can be kept as investments, sold for cash, or used as collateral for loans. So that's participation certificates. Then you have private conduits. Commercial mortgage-backed securities, CMBS. Commercial loan funding for the sale of mortgage bank securities. And conduits, this is originations that originate commercial and multifamily housing loans for purposes of pooling them as collateral for the insurance of CMBS rather than holding them in the lender's own portfolio. So they go ahead and pool them all together and they'll go ahead and let somebody invest in it. Many private conduits did not properly monitor the quality of the loans that were being made in the primary market and didn't exercise proper due diligence in managing the loan portfolio. And there's a lot of that. We'll be probably watching a video coming up of the fall of 2008, and that was another thing. They would pool all of these loans that the credit rating said that they were double or triple A credit, which was a good credit, of all these mortgages, but actually they were not. They were trash. They came from all over the place, and they bundled them up, and then they sold them. And they sold them to different countries, too. And when the housing crunch and when the bubble burst, all of those were pretty much worth nothing. So all these companies and people's pensions bought into them all over the world. They just lost all their money because they weren't worth anything. It was really bad. There was over $4 trillion lost in the 2008 financial crisis. So just think of $4 trillion being gone overnight. Really something. This is on page 230 we're talking about. And let's see if there's anything else I need to. No. So now they have automated underwriting systems. This is a computerized system for loan approval communication between the loan originator and the investor. So the process for Freddie Mac's loan prospector program is very streamlined. So number one, the regular uniform residential loan application is submitted to the lender. The lender then verifies the applicant's employment, income, and assets. Information is fed into the computer and is promptly analyzed by the computer program. If the borrower is accepted, and if the loan-to-value ratio is greater than 80%, the application is then forwarded to the private mortgage insurer. Okay, so it's done by them first and then forwarded over. Those that are not accepted are considered as refer or caution and sent to the underwriter department. So what the underwriter will do will come back to the borrower and they'll say, hey, we got this that needs to be taken care of before you can actually get this loan. There's this, so They're a lot tighter with the loan situation now than they used to be. So mortgage money on page 232. To create mortgages, money must have a source. The sources are savings, generally by individual and businesses, as a result of their spending less than they earn. Okay, real savings. You have to have this in the bank. You have to have some savings in the bank if you want to get a mortgage these days. And it's called real savings. And government-created money, fiat money, or printing press money. Okay, so that's government-related. Usury. State legislation that imposes an interest rate ceiling on loans. U.S. Congress passed legislation that exempt from state usury limits most first lien home loans made by institutional lenders. It's on page 233. So an old idea that has been tried, but is dubious value for holding down interest rates, is legislation to impose interest rate ceiling, known as usury. Other financing conditions, okay? There are a number of factors that determine the overall cost of a loan, including the following. Price to the borrower. You got alienation clause. So the alienation clause is also a due on sale. It's two different names there, but same thing. In the past, these were inserted by lenders so that if the borrower sold the property to someone considered uncreditworthy by the lender could call the loan balance due. All right. So, also here on the alienation, call clause, due on sale clause, requires immediate repayment of the loan if ownership transfers. All right. So if ownership transfers, they can say, "Hey, I want that loan paid right now." Then you have a prepayment penalty. Penalty for the right to repay a loan early. And I have down here, a typical prepayment penalty amounts to the equivalent of 6 months' interest on the amount that is being paid early. Other contracts may make the penalty stiffest when the loan is young. So if you just got the loan on there, they may really stiff you with the prepayment penalty. In certain states, laws do not permit prepayment penalties on loans more than 5 years old. All right, so there you go, prepayment penalty on that. A lot of times, banks will not have a prepayment penalty as long as you're a good creditor with them. So if you have really good credit rating and all that other stuff, then they know that you probably won't be paying it off anytime soon anyway, so they don't put that in the paperwork. Always ask when you go for a loan, is there a prepayment penalty on here? Okay, because a lot of times if you want to refinance a loan, you'll pay off this other loan to be able to refinance. Well, if you pay off this loan too early at this one company, then they'll give you a prepayment penalty on there. So as long as you don't have one there, you can do it. You can go ahead and pay off that loan and get you a better interest rate and refinance the loan. So make sure you always ask. Again, we got key terms, alienation clause, Fannie, Freddie Mac, mortgage broker, secondary mortgage, usury. We went over all those. And we are ready for the chapter code for chapter 13, and that is usury. So chapter code for 13 is usury, and we just talked about that. So chapter 14. This moves along so quick with wonderful financing terms. And here we are, bringing it on up. Yeah, with loans, and there's so much to it. And you can't learn everything in one sit down. It takes a lot of times to really know the mortgage business. It takes years to know of all the ins and outs. So don't worry if you don't get everything in one day. So, types of financing, chapter 14. Adjustable rate mortgage. So adjustable rate mortgage is one, the interest rate rises and falls with the changes in prevailing interest rates. Okay, so that's almost all of them out there are adjustable rate mortgages. there's adjustable rate and then there's fixed rate, and you want to go ahead and get a fixed rate mortgage when you do a long-term loan. But adjustable rate is for a lot of times it's what to look for in it. You can look for the interest rate, margin, adjustment period in there, interest rate cap, payment cap, negativity amortization, and disclosures. Okay, so that's 238. So adjustable rate mortgage, the benefit of it is to carry interest rate that is lower than the rate on the fixed rate mortgage of a similar maturity. Okay, so you can get adjustable rate mortgage. You can usually start out with a lower interest rate than a fixed rate, because what it does, it goes up and down depending on the market. All right. This often makes a difference between being able to qualify for a desired home and not qualify for it. So if market interest rate falls, the borrower's monthly payment falls. So right now, their interest rate is way low between banks borrowing from each other. So it makes the interest rate lower. And if inflation happens, that's going to make the interest rates go up. So they just came out, the finance gurus out there with the government said that looks like interest rates are not going to go up until a couple years from now. They're going to try to keep them the same. So this would be a good time to keep that interest rate, that adjustable rate mortgage for a while until the rates start climbing. And once they start climbing, then your monthly payment starts climbing with it, right? Because it's adjustable rate with the market. So you can keep your adjustable rate mortgage for a while, and then you want to refinance to a steady interest rate once it starts rising. So there's a lot to it, like I said. The disadvantage is the interest rates rise, the borrowing is going to pay more. Again, so interest rate. The interest rate on an ARM is tied to an index rate between the banks. An index rate moves up and down, so do the borrower's payments when adjustment time arrives. It reflects current market conditions. The most popular index is based on an index that includes interest rates of all treasuries and securities, from 3-month bills to 30-year bonds. This index, called a 1-year constant maturity treasury, is published by the Federal Reserve based on daily calculations. So again, I said that the Federal Reserve actually just came out and said they're going to keep rates the same. They're trying not to raise any rates because the economy right now is kind of flat. So they don't want to mess with anything. So that way they can loan more money and people can, try to purchase more stuff. Then you have a margin. The margin is for the lender's cost of doing business, risk of loss on the loan, and profit. Currently, this runs from 2 to 3%, depending on the characteristics of the loan, and that's margin. Then adjustment period. This is the amount of time that elapses between adjustments. So it all depends on when they say their adjustment, they're going to adjust your loan and all that. Interest rate cap. Lenders are now required by federal law to disclose how much the interest rate can increase for any one adjustment period during the life of the loan. So they have to disclose that now to you. And payment cap sets a limit on how much the borrower monthly payment can increase in any 1 year. So before, they could increase up and down, just like credit cards. Now they have a cap on them. It's still very high. It's 20-something%. But before, they didn't have a cap. So they could charge all kinds of real high interest on people and, try to take advantage. And the government stepped in and they said, nope, not anymore. Negative amortization. Instead of the loan balance drop each month as loan payments are made, the balance owed rises. That won't be good. This can bring concern to the lender, who can visualize the day the loan balance exceeds the value of the property. Re-amortized in this situation means the monthly payments will be adjusted upward by enough to stop the negative amortization. You do not want negative amortization being happened to you. And then disclosures. Regulation Z, which we talked about before, requires creditors to provide consumers with more extensive information about the variable rate features of ARMs, adjustable rate mortgages. The maximum interest rate must be stated as a specific amount or stated in a manner in which the consumer may easily ascertain the maximum interest rate at the time of entering the obligation. So that's disclosures. So you have a little drawing there of an adjustable rate mortgage. You have your monthly payment and then life of the loan in years. And you see the adjustments making. It's almost like a staircase. Interest rates fall or the Fed lowers rates, then you'll see it going back down. So it keeps on going up and down. Well, that's good if everything's going good. But there's always something that can happen in the market where the interest rates will just start to skyrocket. Back in the 70s, interest rates hit 18%. During the crisis, when they had the gas crisis and all that other stuff that was going on back then with President Jimmy Carter. So interest rates were up 15 to 18%. Just imagine. So that would be huge monthly payments you'd have to be making just on the interest of the house, especially on a $300,000 house. Just think of that. So what you would want to do is do a constant rate instead of the adjustable rate. And we'll be talking about that here in a minute. Other financing. The number of alternative types of financing continues to expand, including the following options: graduated payment mortgage, equity sharing, rich uncle financing, maybe Uncle Joe, and package mortgage, 241, 242. So graduated payment mortgage, this helped borrowers qualify for loans by basing repayment on scheduling on salary expectations. So it all depends on what their salary was. This type of mortgage, the interest rate and maturity are fixed by the monthly payment gradually, and it rises. Equity sharing. In return for providing financing, the lender wants to share in some of the benefits normally reserved for the equity holder. We talk about equity before. The equity holder would agree to this either to get a lower rate of interest or to get financing when financing was scarce. So they could actually borrow against equity. Then you have rich uncle financing, a second variation of equity sharing. Investor may be a parent helping a son or daughter buy a home. So your parents could actually try to help you out a little bit on maybe doing a down payment on a house. Giving the parents the right to occupy it. Each party has a right to a portion of any appreciation, the right to buy out the other in this situation. Then you have package mortgage. This is possible to include items classed as personal property in a real estate mortgage. Such items as a refrigerator, clothes washer, dryer can be pledged along with the house and land in a single mortgage. For the borrower, it offers the opportunity of financing major appliances at the same rate of interest as the real estate itself. Okay, so you can put different appliances and stuff in the mortgage. I don't know if that's good, but it may work for some people. A blanket mortgage. Let's see here. Other financing. Blanket mortgage. A mortgage secured by two or more properties is a blanket mortgage. You want to buy a house plus the vacation lot next door. Financing the purchase with a single mortgage that covers both properties. You're blanketed both of them. One mortgage instead of two is a savings. Better terms than if they were financed separately. So blanket mortgage is pretty good, especially if you want to do two different properties. Then you have reverse mortgage. The lender makes a lump sum payment to the borrower, who in turn repays it through monthly payments to the lender. This happens a lot with elderly people. They'll have their house paid for, and they say, hey, I need extra money a month to go ahead and buy groceries or whatever else. And this is what the lenders will do. They'll do a reverse mortgage for them. And they'll take the equity of the house, and they'll give a lump sum amount for that equity to the people. and then they repay it over time. And it's good and bad. Sometimes the family gets stuck with it after the parents pass. So there's a lot of different things with reverse mortgage that you have to know about. This is valuable for elderly homeowner who does not want to sell, but whose retirement income is not quite enough for comfortable living. The homeowner receives a monthly check, has full use of the property, and is not required to repay until he or she sells or dies. Okay, so we talked about a balloon note earlier. At the end of the thing, there's a huge balloon. Well, this is pretty much a balloon deal when they die. They'll take it out of the estate of the people or the family. So they get their money first before anybody else gets their money. Construction loan. This is money in advance for construction to take place. So they'll go ahead and give you a percentage of the loan up front, and you give the money to your builder, and you can go ahead and break ground. You can do all the plumbing, you can do all the foundation, you can do all this other stuff. And what they do, they'll come out and inspect as this goes along. And say, okay, is this done? Yes. So they'll go ahead and give them another 15% of the loan to go ahead and start the next process of building the house. So it just works on itself. It's not a bad deal. Called construction loan. Lender will parcel out the loan as the building is being constructed, always holding a portion until the property is ready for occupancy. Some lenders specialize only in construction loans and do not want to wait 20 or 30 years to be repaid. Okay, so it's a lot of lenders do that. Equity mortgage. On page 244. This lender agrees to make a loan based on the amount of equity in a borrower's home, generally 70 to 80% of the home value. Okay, so you can get a home equity line of credit on your house. It's very useful. We've talked about it before. If you have your house paid for 50%, then they'll give you a loan of that 50% of 70 to 80% of that amount. So you can go and put in a driveway, you can do whatever with the money, and then it becomes kind of like a second mortgage. Done without having to refinance the first loan, and uses the home as an asset against which homeowner can borrow and repay as needed. So a home equity loan, like I'm talking about, is kind of like just like a piggy bank. And once you pay down that second mortgage, it rises over here and puts more money into your piggy bank. And it's just like a loan that you can just keep out there forever and use it when you need it. It's very good to have one on your house. Now, if you invest with it and your investment goes bad, then it could put a lien on your house for that amount, and you can actually lose your house over it. So you want to make sure that you're able to make your payments on your home equity loan, because it could be negatively affecting your other house. And then affordable housing loans covers many slightly different loans that target first-time home buyers and low to moderate income borrowers. Freddie Mac now offers two programs supporting construction of affordable single-family homes in urban centers. One allows builders to cover up to 3% of a borrower's down payment. The second mortgage product benefits builders by reducing some of the economic risk associated with the building of homes in urban centers. So that's a pretty good deal there. Affordable housing loans. And here, talks about affordable housing loan as an umbrella term that covers many slightly different loans. And again, targets first-time home buyers and low to moderate income borrowers. Underwriting standards are modified to recognize different forms of credit responsibility. Pre-purchase home buyer education. Low down payments on it. That's the best thing. Because it's government ran, you can get a low down payment and you can get into a house a lot cheaper. So, more financing. Other developments in mortgage lending include, you got 97% conventional loan, the NEMA program, the seller financing, and contract for deed. These are all in 246. The 97% conventional, one of the most significant developments in the mortgage lending has been the introduction of the 3% down payment conventional loan. And the Community Reinvestment Act provides strong investment for private lenders to engage in affordable housing loans to help lower to middle income owners. So that's 97%. It's a pretty good deal. The NEMA Corporation was founded on the NEMA program with a $5,000 grant from a local Baptist church in 1994. Imagine that. With the intention of rebuilding parts of Sacramento, California. It has now grown into a national program handling over $150 million a year. Wow. It has become the largest down payment assistance program in the United States. It now operates in 4,900 cities in every state except Hawaii. Usually 1 to 6% of the loan amount is done. After closing, they called a service fee to the Neiman pool. There's a contribution made. So that's how they get their money. Then you have seller financing. When a seller is willing to accept part of a property's purchase price in the form of a buyer's promissory note, accompanied by a mortgage or deed of trust on the property, where an existing mortgage is being assumed by the buyer, where the seller prefers to receive the money spread out over time with interest instead of a lump sum cash. Okay, so my parents actually did this. I think I talked about it before. They bought a farm from a lady, and she went ahead and assumed the seller financing on that. So she said, okay, give me a lump sum down. So they probably put down, who knows, this was back in the 70s. They did this a lot back then. It was a good way of getting into a piece of property. So they gave her so much down, and then they said, okay, what interest do you want on the mortgage? And so they did an interest rate, and they locked it in, and they did a deed of trust, and what my parents did was just make payments to her instead of to a bank for the, I think they did it for 20 years. So it worked out pretty well. And they were able to pay off the loan, and the interest rate was really good that she gave them. So seller financing, a lot of people do it. Not me though, because I don't have bank written across my forehead. I always tell that to people when they say, will you do seller financing for your house? I say, sorry, I don't have bank written on my forehead here. So, contract for deed. This enables the seller to finance a buyer by permitting him to make a down payment following by monthly payments. However, title remains in the name of the seller. So that's contract of deed. The title remains in the name of the seller. Financing. Here's this little dude walking. Big old bag of money. Other financing tools have emerged over the years, including the following. You got an option, you got rental, and land leases. Option provides a method by which need to finance the full price of a property immediately can be postponed. For example, this is used by developers a lot. Developer is offered 100 acres of land for a housing subdivision, but is not sure that the market will absorb that many houses. The solution is to buy 25 acres outright and take 3 25-acre options at present prices. So he can say, hey, at this price, you can lock this in for me on the remainder. If the houses on the first 25 acres sell promptly, the builder can exercise the option to buy the remaining land. Okay, and then sometimes what they'll do is say, okay, give me a lump sum down, and I'll hold this property for you. So it all depends, it's all negotiable. So that's an option. Rental. Even though tenants do not acquire fee ownership, rentals and leases are means of financing real estate. Leasing is an ideal method of financing when the tenant does not want to buy, cannot raise the funds to buy, or prefers to invest available funds elsewhere. Some people never want to buy. My grandfather never wanted to buy a house. He always said that he wanted to be able to get all his clothes together or whatever else and leave and not have to worry about the house or selling the house or anything else, so he always rented. There's a lot of people out there, so that's why it's good to get into the renting business, because there's a lot of people that like to rent and never buy, and it works out for everybody. So. Land leases. These are common throughout the United States for both commercial and industrial users of farms. Homes built or leased land are commonplace. Okay, so if you have a farm, you can lease out pieces of it to people and get money for it. Typically, these leases are at least 55 years in length and bearing an agreement to the contrary. The improvements to the land become the property of the fee owner at the end of the lease. So if you lease this property and you build a big barn on it, well, it becomes the owner's barn after the lease is done. So. Now, I'm sure you can have it written out in the contract, in the lease contract, that you can actually remove whatever you put out there. But whatever you leave on the property becomes, a fixture. So Chapter 14, key terms. We had adjustable rate mortgage, you got the blanket mortgage that we talked about, construction loans, options out there, seller financing. So all that stuff is different types of financing. So that's pretty neat. So we're going to go ahead and go to our last chapter. And before we move on, the chapter code for Chapter 14 is blanket. So we have a blanket mortgage we talked about. So the code is blanket. And I think go ahead and close this one out. We're going to go to Chapter 15. And I think Michael Jackson actually named one of his children Blanket. So that's a little trivia for you. And slideshow from the beginning. All right, Chapter 15, taxes and assessments. So everybody's got to pay, two things that you know in life that you can always count on is taxes and death, two things in life. So everybody pays taxes. You're not going to get out of paying taxes. And this is just introduction of taxes. Property taxes, huge up north. A lot more expensive taxes in New York and other places than here in the South. Of course, we're in the South down here in Tennessee. Property taxes. Important terms and considerations regarding property taxes include the following: budget and appropriation, appraisal and assessment, ad valorem tax, source of income, tax district, and tax rate calculations. So, property taxes. You got budget and appropriation. Each taxing body with authority to tax prepares its budget for the coming year. They always do next year. They budget for it. Each budget, along with the list sources from which the money will be derived, is enacted into law. Appropriation processes: estimated sales tax, state and federal revenue sharing, business licenses, and city income taxes are subtracted from the budget. So that's budget and appropriation. This is for the states. This is on page 256. Appraisal and assessment. The state assessor's office appraises each taxable parcel of land and improvements therein. So they do this every so often. Nashville just had a new assessment done on their taxes of all their land. They might do it every 4 years sometimes. All depends on the state. Appraisal procedures vary from state to state. Value is the estimated fair market cash value of the property, and then they tax on that. The appraised value is converted into an assessed value upon which taxes are based. So again, the value, they say, okay, your house is worth $300,000. We have a percentage of tax that we tax, and you have to pay this amount. So you'll get a tax bill in the mail, and you got to pay it before the next year. Or they will put a lien on your property, and you can't sell your property or do anything else until that tax is paid. So tax rate calculation.
The assessed values of property subject to property taxation are added together in order to calculate the tax rate. This levy can be expressed in three ways: as a mill rate, as dollars per hundred, or as dollars per thousand. All three rating methods are found in the United States. A mill rate, and I think that's on the next page, we'll be talking about that. Tax rate calculated in three different ways there. Let me go to the next page. So calculation of a mill, you move the decimal point. All right, 85 mils, you move it to the left 2 places. So 85 mils equals 0.085. You have 215 mils, 2.15, and 5 mils, 0.005. So result tax bill, it's tax appraised value, asset value, and mill rate. Okay, those all three are within that tax rate. Taxable bill. Other taxing matters. Other taxing matters include unpaid property taxes. Okay? If you own real estate and fail to pay the property taxes, you will lose the property. Imagine that. In some states, title to delinquent property is transferred to the county or state. So it's just transferred over. A redemption period follows. Owner or any lien holder can redeem the property by paying back taxes and penalties. If redemption does not occur, the property is sold at a public announcement auction, and the highest bidder receives a tax deed. Okay? The purchaser entitled to a deed does not step forward and redeem it during the redemption period that follows. If it is not redeemed, the purchaser receives the money back plus interest. Okay, so if you go to the courthouse and they have these tax sales, they have all these properties and they're listed in the paper, and they say, okay, these people didn't pay the taxes on this property. All right, make sure you go and look at the property. Okay, I actually went to one of these before, to a tax sale, and they said, okay, property on 300 Church Street, right? So they start bidding, and we bid on it and everything. We thought the property probably had a house on it, probably, older than the Hills house, but, something on it. So we bid on it and won the bid. So we went out to the property afterward, and lo and behold, there was no house. We said, where's the house? And we said, wait a minute, there's a house there, but that's not on this property. So it was actually the land that we purchased. So no house. So actually we just kept it for a while, and then we resold it, and another person put a house on it. But you have to go and investigate what you're bidding on, because being naive and not knowing is not an excuse. They will not give you your money back. So make sure you know what you're buying. So what happens is, once the house sells for a tax lien or whatever, at a tax auction, the people that actually owned the house before has a whole year to be able to pay those back taxes and get their house back. All right? So you might buy it for a really good price, but you have to wait a whole year before you actually work on that house, just to give these people the opportunity to go and give that money over to buy that house back. Most of the time it does not happen, because if they can't pay the taxes in the first place, then they can't pay them later on either. So, but you do have a waiting period. So that's a redemption. There's a time period there. So they have assessment appeal. Again, this is on page 258. By law, assessment procedures must be uniformly applied to all properties within a taxing jurisdiction. An owner who feels overassessed can file an appeal before an assessment appeal board. Okay, there's a whole board. Assessment appeal board. Note that the appeal process deals only with the methods of assessment and taxation, not with the tax rate or amount of tax. So it does not deal with those two things. It only deals with methods of assessment and taxation. So if you think that they came out and assessed your property for way too much, which sometimes they may do that. That way they'll get more money. It all depends. You can go in front of the board and say, hey, this property is not worth this, and just give them all the different reasons why, and they may reduce that amount you have to pay in taxation on that property. So they do have a board that you can go and say, hey, this ain't fair, you know, I need to pay less for this. So that's what they're talking about there. Property tax exemptions. More than half the land in many cities and counties is exempt from real property taxation. This is because governments and their agencies do not tax themselves or each other. So because governments and their agencies do not tax themselves or each other. Most land is owned by the government. You go out there in Arizona and it's all different parts of the world, well, in the United States, and you say, who owns this piece of property? Well, more than likely the government owns it. So they're the biggest landholders in the whole United States. And they do not tax themselves. So a lot of land is not taxed. That's what they're saying there. Property tax exemptions are used to attract industries. Okay, so what they'll do is the city, the mayor will say to, let's say, Amazon, which they did this in Nashville just recently. They said, okay, Amazon, we'll go and exempt you. You don't have to pay taxes for 30 years or whatever deal that they made on this property if you build a huge manufacturing plant. And so they say, okay, well, can you do it for more years than that and make it a little bit sweeter deal, because this other state is trying to get him to come over there too. So it's a tax exemption that they can bring companies in, and it works out very well for cities a lot of times. So Nashville is getting a huge Amazon corporate office here being built starting this year. So property tax variations. Property tax on similar homes within a city or county can vary widely when price change faster than the assessor's office can reappraise them. Okay, so your property value goes way up, right? And you can sell your house and make a whole lot more money on it. And the tax assessor hasn't been around for 3 years or whatever to reassess all the properties. So the actual amount of property can go up a whole lot faster than what the tax assessors can do. So, as an aid to keeping current on property value changes, states are enacting laws that require a real estate buyer to advise the assessor's office of the price and terms of the purchase within 90 days after taking title. So they want the people that actually buy the house to go ahead and let the tax assessor knows what they paid for it, and they can make adjustments on the tax rate. Special assessments. Often the need arises to make local municipal improvements such as paving of streets. This will benefit property owners within a limited area. Okay, so it's a special assessment there. The area receiving the benefit of the improvement is an improvement district and an assessment district, and the property within the district bears the cost of the improvement. So, you get a new road, your taxes might go up a little bit. It all depends. Now, the person that lives down the road from you that didn't get a new road put in doesn't pay as much, so they make just a special assessment there, a special change on the tax rate. So it's fair, especially if they make things nicer in your area, then your house is going to be worth more, then you're going to pay more in taxes. Federal income tax. So there's basis. It's on page 262. The price originally paid for the property plus any fees paid for closing and improvements used in calculating income taxes. That's the basis. If the home was built rather than purchased, the basis is the cost of the land plus the cost of construction, such as the cost of materials, labor, and other things. The value of the labor contributed by the homeowner and free labor from friends and relatives cannot be added to that. Okay? Again, the value of labor contributed by the homeowner and free labor from friends and relatives cannot be added. So a calculation of gain here. So you buy a home for $200,000 at closing costs, or $1,500. Add landscaping and fencing for $10,000. Add a bedroom or bathroom for $45,000. Sell a home for $325,000. Sales commissions and closing costs are $26,000. Okay, so you have the basis of 201, then the basis is the 211, and then it becomes 256.5 basis. Amount realized is 299 less the basis. Okay, so they have the amount there, and then the less basis of 256.5 equals a gain after everything has been made of $42,500. So that's a calculated gain, and they can actually that's what they'll tax you on, is that gain of the $42,500 that you have to pay to the government. So it's capital. They call it a capital gains tax. So if you buy a house that you want to just flip, you go ahead and you buy it for the $200,000. You put $45,000 into it. You sell it for $300,000. Then the difference between $245,000 and the $300,000, that's your capital gain that you made, and that's what they're going to tax you on. A lot of times, if you sell within a year, it's 28% tax on that, right to the government. If you hold on to 2 years, it drops down to 15%, and so on and so forth. So it all depends on what state you're in too for different taxing. Income tax exclusion. An income tax exclusion is a special rule that applies for a taxpayer when there's a sale of a principal residence, used for 2 of the last 5 years, okay? Married, excluded up to $500,000 gain, and then single, excluded up to $250,000 gain. So I talked about capital gains tax, right? Well, if you stay in your home up to 2 years, then there's no tax that the government on your capital gain of what they want from you. But you got to stay there 2 years. So of course I took advantage of that, and we were moving every 2 years or 3 years, and our family were like, "Why are you doing this?" You know, every time they made out a new Christmas card, there would be a change of address on it, and everybody said, "I can't believe you're moving again." Well, we actually did that, and you can do that. And what you do, you take your capital gains and you put it on your next house, and you just keep on building up the size house that you get until finally you get to where you can actually pay off a house and have it paid in full, and the mortgage is paid for, and you don't have to worry about a mortgage anymore. So it really helps out. So that's a way of gaining wealth, is to move a lot, and it's using this law that they have about capital gains that you can use. It's not really a loophole, but it does help out people being able to get a nicer home and whatever else, or gain wealth. So here again, if you lived within past two of the past 5 years, you get that capital gains break. So a married couple, if you bought a $100,000 house and you sold it for $600,000, wow, what a deal, right? Well, if you're married, it's $500,000 gain. You won't pay any capital gains tax on that. So you just pocket it. Say, "Thank you." And you put that on your next house or whatever. It's very unusual somebody going to make that kind of return on their house. And then single people, you get $250,000 gain. So that's not taxed. Pretty good deal. So talking about capital gains tax rates, the Tax Cuts and Jobs Act of 2017 reduced capital gains tax for joint filing taxpayers too. All right, so 0% for those with incomes of $77,200, 15% for those incomes up to $479,000, and then 20% for those incomes over $479,000. That's the capital gains tax rates. All right, and that's big checks people give to the government whenever they go and sell and have to pay capital gains. Installment period is on page 265. Installment method: sale of real estate in which the proceeds of the sale are deferred beyond the year of sale. Okay, again, sale of real estate in which the proceeds of the sale are deferred beyond the year of sale. If you sell by the installment method, that is, you sell property at a gain in one taxable year and receive one or more payments in later taxable years, the installment method of reporting is actually automatically applied. If this is not suitable, you can elect to pay all the taxes in the year of the sale. The installment method is only available to those who are not dealers in real property. All dealers in real property are required to pay all taxes in the year of the sale. You can't defer them to another year. So, it's good to talk to your accountant about deferring any taxes, because they'll say, well, you might as well go ahead and pay them this year, or yeah, I guess you can pay them next year. Talk to your accountant about it, because it matters. Tax deductions. This is on 265 also. Internal Revenue Code provides for a deductibility of state and local real estate taxes up to $10,000. And so that just did that, and they're trying to change that. But I think they actually changed that up in New York, and people were upset about that. So don't quote me on that, but there is a deductibility of state and local real estate taxes up to $10,000. So capital gains, again, amount realized. Okay, amount realized, the selling price of the home less selling expenses, and then gain on the sale. To calculate the gain, you must subtract the selling expenses from the sale price. Very easy. Okay, and then subtract the basis to determine the gain. And we did that before on the basis situation. On page 266, tax rules of real estate are continually changing. Because tax rules for real estate are continually changing, there is a high impact on real estate. The need for more frequent and detailed information is needed, and agents' liability for tax advice. So again, talk to your tax accountant if you have any questions, because they are up with all the rules changing every year. They have a whole list of things that they have to go over before tax season. So it's constantly changing. The impact on real estate. As a real estate owner or agent, you need a source of more frequent and more detailed information, such as annual income tax guide published at the Internal Revenue Service. And it's free, so you can get that. Be aware that tax law changes have an impact on real estate values, which, we all know that, right? Agents liable for tax advice strongly suggests that a real estate agent be responsibly knowledgeable about taxes. Okay, so you need to know some knowledge if you're going to be talking to buyers and sellers about their taxable situation. Hopefully they don't really get into that much with you. They'll talk to their accountant or whoever else that they deal with, or the bank. It's they might be a little vague on taxes, and you can just fill them in a little bit on it, but tell them that they need better counseling if they have deeper questions. Agents should have enough general knowledge of real estate tax laws to be able to answer basic questions accurately and to warn clients and recommend tax counsel. So what did I say? Talk to your accountant. This is to avoid situations as like, gee, I didn't know I had to pay all these taxes. My agent should have warned me. Well, you don't want them saying that to you after or at the closing table. They say, hey, I didn't know about this tax or that tax or how much this and that. And so it's good to fill them in on all the different things on the closing statement prior to the closing. That way there's no, what's this, or why is this here, or anything else. But a lot of times you'll be with a closing attorney, and they can go ahead and instruct them on different questions that they have about the closing that you might not know about. So that's why it's wonderful to have a closing attorney. because that way you're not stuck with all the hard questions, because they know a whole lot more than the real estate agent on almost all those different law terms. So, that's chapter 15, taxes and assessments. So we have adjustable basis, we got documenting taxes, mill rate, there's tax certificates, tax liens out there. Let me give you the code for chapter 15. A lot of chapters running around here. So the chapter code for 15 is mill. So we had a mill rate. So it's M-I-L-L, mill, for chapter 15. So, again, please read all the chapters and make sure you go over your review questions. That's about 80% of the test is review questions. So make sure you go over that and do them all. And we'll be back again with more chapters here coming up soon. So thank you very much for your time, and we'll be talking to you very soon.